This video is how to trade crypto on MEXC. I'm going to show you trading both in the spot market and in the futures market. These are very different. The spot market is where we buy and hold cryptocurrency. We wait and hopefully take our profits later. Futures, this is for shorter term trading, day trading, more speculative positions. We can actually benefit from the price going up and going down. It depends what position we want to take. So I'll show you the differences between them both here. What we're going to look at firstly is simply buying crypto on MEXC and how to actually put our orders in. Now, if you are new to MEXC, make sure to get your deposit bonus. If you are a new user, you can click the link below in the description and you can get a deposit bonus of up to $20,000. Although if you put less in, you still can get some deposit bonuses. So if you are trading anyway, you might as well take advantage. Link below for the details there and if it's available for you. So spot trading. We've got our fiat currency, we've got our stablecoin on the platform. How do we actually go ahead and trade? Well, the first strategy here is buying the crypto in the spot market. That's it. Buying it, holding it, and waiting. It's a very good strategy that's made a lot of money. I'll show you why. If we go over to this, so I'll leave all of these links below. You can see all of this yourself. This is the compound annual growth rate of Bitcoin. So if you buy once a week or once a day or once a month, and you're just consistent doing that, what is the compound annual growth of the asset? You can see this orange line here. Right now, as of making this video, the CAGR of Bitcoin is 53% a year. So if you just buy Bitcoin once a week and you wait and you wait and you wait, you buy the highs and you buy the lows, but you just do that over the long term, you're making annualized 53% on your investment. So it's a very good strategy. It's simple. It takes 2 seconds a week to do, and it is making money at this point, right? So that is a great strategy, I think, for the bulk of our portfolio. How do we go ahead and trade this? I'll show you how to trade on the spot platform with market orders and limit orders. Now, I've got some stable coins in the MEXC platform already, but if you need to know how to do that, how to deposit money into MEXC and sign up for an account, I'll leave a beginner's guide down in the description. But from here, we're going to choose the asset that we're trading. So I've got some USDC, which is a US dollar stable coin. So essentially US dollars, just the crypto version. I need to swap that into a crypto. So I can search on the spot trading platform here. So let's search for Bitcoin. You can see all of these different trading pairs, right? So BTC is the ticker for Bitcoin, right? So BTC is what I want to trade. Now, what am I trading against? Well, I've got some USDC. So I need to find the Bitcoin USDC trading pair. But you can also see a trading pair here for USDT, which is another stable coin. These are the futures markets here, the perpetual markets. USDC, that's the one I want to trade. You can see some other trading pairs here as well, right? So you've got ETH against BTC. That's where you're buying and selling ETH and BTC together. So if you want to sell ETH to buy Bitcoin or sell Bitcoin to buy ETH directly, you can trade that pair, right? So choose the pair that you want. There's always a pair of assets because you're always selling one asset for another, right? So BTC, USDC. That means that I'm going to be selling my USDC and buying BTC. So I'm going to click that. And this is the chart of this trading pair. You'll see that if you choose other trading pairs, the charts will be completely different because each currency is obviously valued in the other currency as a trading pair. Sell one to buy the other. So you can just search that on the left-hand side. So what do we have here? We have the price up here. This is the 24-hour high and low. These are the prices that they've traded at. You can see the trading volume, just some important information here. Now, on the right-hand side, this is the order book, and this is where we trade. Now, if your trading system doesn't look like this, go over to settings, and then you can manipulate anything that you want. So I've got dark mode here. Because I'm from Europe, I do green for up and red for down. Although if you're in Asia, you may actually use the blue or the other way. So that's up to you, wherever you want to have that. And I've just got the vertical layout here. Horizontal, I think, comes as standard, or the standard one here, which is a little bit different. I like the vertical, so I've done that. And you can get some alerts when you enter trades and things like that that you may want to turn on or off. That's up to you. So from here, how do we enter a trade? So what you can see is you can either buy or sell, and it doesn't matter as long as you have the pairs, right? So if you're selling, what does that mean? Well, I'm selling Bitcoin here and I'll be selling it for USDC. I don't want to do that. I want to buy Bitcoin and sell my USDC. On the left-hand side, this is the order book. So this is the market in this trading pair. There are other traders here, probably a lot of bots as well that are working orders for certain different traders. And you have sellers up at the top here, and you have buyers down at the bottom. This price in the middle, this is where a buyer and a seller meet and actually trade. So that's the last traded price. It's green because that was essentially a buy order, which means that someone traded up here and actually took this guy's offer. So up here, these are sellers. These are known as asks if you're American, or if you're from the UK or Europe, it may be known as an offer. They're just on the offer. They're offering their Bitcoin out. This is the price that they're willing to trade at. Obviously, the higher the price, the higher up on the order book it goes. These guys are down here and they're bidding. These are bidders. So they're placing their bids below the price. Obviously, buyers want to get cheap prices, sellers want to get expensive prices, but whenever they meet in the middle, that is a trade, and that's where that price is. And you can see this is a red trade now, and that means that someone actually sold to a bidder. So if your prices are apart, how do you actually trade? Well, there's two ways to trade, a market order and a limit order. So let's go through market order first. Market order here, what does that mean? This is like going to the airport and going to TravelX or something. They tell you the price for the currency that you want to buy. You don't have any say in that. You just have an amount of your currency and they're telling you what the price is. So you say, I've got $100 and how much euros can I get? And they're going to tell you. Well, that's what a market order is. So a market order is when you tell the market, or you tell the MEXC trading system, I want to buy $100 in this case, because we're trading USDC. I want to buy 100 USDC worth of Bitcoin. So you know exactly how much you're spending because you've got that, but you do not choose the price that you trade at. It's a market order, right? So what you're doing is just taking the best possible price that's in the market right now. Now, what's the best possible price? Well, it's not any of these down here because these are cheap and these are not trading. What you actually do is go right up and you trade this price. Someone is physically offering that Bitcoin on the market at that price. They're on the offer, right? And so they're trading at 661.28. So what you would do when you press this, buy BTC, is you'd sell your 100 USDC or USDT or whatever, and you would just take the best offer at the current time, bang, and you would trade it immediately. That's fine. It's easy, right? You can do that. So you can do that and you'll just get this price right here, and that's it. Now, that's fine. We'll go ahead and just press buy BTC and you get the $100 worth of BTC. No big deal. If you're dollar cost averaging, not really a big deal what you trade at, right? Because you can see the spread here is tiny. 63,661.27, 63,639.65. It's jumping around, but it's very, very small difference, right? So if you want to just go ahead and buy, press buy. Now we're going to look at limit orders and we'll actually put one of these in. So a limit order here, we're going to press limit. With a limit order, you have complete control over the parameters of the order. You control the amount that you trade and also the price that you want to trade at. Now this is different because if we're controlling the price that we trade at, we may not trade straight away because we may have a price that is away from what traders want to trade at. So let me explain this. We have the price now and the amount. You can see with market order, you just choose the amount that you spend. With limit order, you are inputting the order. So what I'm going to do is I'm going to spend 50 USDC, but I'm going to say that the price that I want to trade at is $62,000 or USDC per 1 BTC. The price is quoted in 1 unit. A unit of Bitcoin is 1 BTC. We, of course, don't have to buy 1 BTC. We can buy any fraction of a Bitcoin. And so now that we have the amount that we want to spend and the exact price that we want to trade at, the system can work out the exact amount of Bitcoin that we're actually going to buy or trade, which is this here, 0.000784. That's how much Bitcoin we can trade because we have both the price and the amount of US dollars that we're spending or stable coins that we're spending, right? So we can actually go ahead and do that. Now, what you can see is my limit order at 62,000 is way too cheap for the current price. Traders and buyers are actually more eager to buy than me because they are bidding 63,000. You can see all of this. So what's going to happen here? Well, we can put an instruction into MEXC to say, this is the parameters of the order that I want and work this order for me. It's going to work it for you. It's going to be in the system. Your trade or our trade here at 62,000 is going to be way down the order book at 62,000, but it's just going to be there waiting to trade if the market gets there. So we're going to buy with a limit order an amount, and this is the price that I want to trade at. I'm going to press buy BTC. You can see the confirmation here. So I've got 62,000 in the price. I'm going to press confirm. Now, what you can see is that we're not going to trade. We can't trade because we're way from the price, right? But the order is in the system. So we're trading Bitcoin against USDC. This is the time that it came in. It's a limit order. We are trying to buy. That's the price that we want to trade at, the quantity that we'll trade, the order amount, etc. And you can see filled. 0% filled. We haven't got any filled yet because you can see the price is way too expensive for us. So that's the limit order. You can put that in. You have complete control over the price that you trade at and the amount. Now, of course, we can edit this as well. So if you press edit, we can edit the price. So 62,000, we're not going to get there. Let's change that to 63,000. And again, the amount and everything here, we can press confirm. We've edited the order like that. And so you can see the order is still down here, but we've now changed this. Okay, you can see that we've changed the price and we're still too far away from the actual trading price, right? So we're still not going to trade, but we can do whatever we want. Now, once the price does get down to 63,000, we'll be right there on the order book waiting to trade and we'll go ahead and actually buy. We need a seller to take 63,000. So what's the difference between a limit and a market order? Essentially, market order gets the order done straight away. Limit order, we can actually choose the price that we pay. We may not trade straight away because we may not have a price that anyone wants to trade at the time. But you can put that in and we're going to cancel this out as well. So we're going to cancel the order. This doesn't cost us anything. We haven't traded anything. We're not paying any trading fees. We're just going to delete the order and cancel it, and that order is gone. So even though we've entered orders here, they're just instructions to the system and we've not actually traded anything. So what we'll do is go ahead and enter a market order just to show you actually getting a trade done. Let's trade some amount of USDC. We're going to press buy, order successfully. That's it. Immediately. So you can see the amount of USDC in my account has now been debited and I now have an amount of BTC in my account. Now do that every single week for a decade and you'll be making 50% a year right now with CAGR. Maybe that will come down over time. That's investing just to do that consistently in an asset that you actually want to accumulate over time. Now I want to give you some extra resources so you can be a little bit more active in the crypto market, or at least identify areas where the price is very overbought, which is when the price is very high in relation to its trend, or when the price is oversold, which is when the price is comparatively low in relation to its trend. What is the trend? How can we identify that? And how can we identify bull and bear markets? So let's go over to the TradingView charts here. Now, MEXC has good charting, but TradingView is ultimate and it's free as well. So I will link it below. We're trading Bitcoin USD here. You can go and open an account. I think it's an email address, and then go down to the charts. And then we're just going to search for Bitcoin USD. Any of these charts work, so you can get that price level. I've just got the all-time price history here. Go to indicators, type in moving average like this. It's moving average simple. You can put a few on here if you want. So I'm gonna put 2 right here. Up here, click on the settings and then inputs. I'm on the week chart. You can see this. This means that each one of these candlesticks is 1 week in length. And I'm going to be looking at a moving average of the price over 200 periods, in this case 200 weeks, because we're on the week chart. So click OK, and that puts it on right here. You can see that. This is a moving average of the price of Bitcoin. This is important because if you're a long-term investor and you buy it every week, your price for Bitcoin and your portfolio essentially will look exactly like the longer term moving averages of the price, right? So that 200 week moving average, right? So if we actually take the Bitcoin price chart away, you'll see this bottom line here. That's the 200 week moving average. And if you dollar cost average Bitcoin, that's what your portfolio will look like over time. So people say Bitcoin is volatile. They're looking at the daily traded price, but the 200 week moving average is not volatile at all. It's literally just going up, right? So that's the portfolio growing over time. Then we have a second one here. We can trade maybe a 50 period moving average. We're going to change the style to white. And there we go. So what does this do? Well, because it's a 50 period, it's tracking the price much more closely, right? So it's not smoothing it out as much. And you can definitely see here, there are areas where the Bitcoin price has very fast appreciations. They're bull markets. Price comes down a little bit. They are bear markets. Another bull market here, another bear market, another bull market, another bear market, and it looks like another bull market here. Very, very clear cycles, right? So what we really want to do is make sure 100% that we're buying the asset that we want to invest in at the lowest possible prices. So we definitely want to be buying when the 50 period is either coming down, that's a bear market, or as it's coming down into the higher time frame moving average, which is this blue line here. Those are areas where we must invest. That sounds easy, right? But it isn't, because during these bear markets, you have panic and FUD, and everyone's saying it's going to collapse down, and you're putting money into a black hole because the price is going down. It's not easy, but if you want to actually make money, that's where all the money is made, because you're buying at lower prices. Buying in bull markets is also okay. Like I said, the moving average, or the CAGR, is 50% a year right now. Even if you bought all of these massive bull markets, right, and the bear markets, you're getting a decent average price, which is the moving average. But we must be active in those bear markets, and that means we must believe in the asset that we're buying. These are the areas where you must buy. We can also go and just put very simple tools on here, like the price range. So you can see, a bull market here, right? Copy paste that. You can change the colors if you want. There's another bull market here, right? You can put this out like this. That's another bull market, and it looks like we're in another bull market right now. So you can place that here. These are bull markets. Now, what do we do during bull markets? We are active during dips in bull markets if we're trading more actively. I'll get onto future trading in a second, but hopefully this gives you some tools and ways to kind of analyze the price movements of BTC longer term. You can see these bull markets. Now, bull markets are important because they have drawdowns and they're trading opportunities, or longer term, you can just invest through them, but make sure you invest in these bear market periods as well, because that's where all the money is made, because you're buying at the lowest prices. If you want to sell crypto back to a stablecoin, we can use the two order types that we've been looking at already as well. So what we need to do is go over to sell. And again, we need to choose the trading pair. So whatever trading pair that you want, you need the crypto that you want to sell and the one that you want to sell it into. So for me, if I sell the Bitcoin that I just bought, I can sell that into USDC if I want. So in a bull market, if I want to take some profits, or I just need some money for something, I can sell out back into USDC, and then I can withdraw that to my fiat currency method. So you'd swap it into USD and then withdraw, or euros or pounds, wherever you are in the world. So what we're going to do is do a market order, sell the amount of BTC. We can choose the amount that we want to sell. We have an amount of BTC in our account. If we choose market order and press sell, we sell immediately. Now, if we choose a limit order, this is the complete opposite to the buy order that we just had. Whereas if we have a price below the current price, so let's put that 62,000 in again. If we sell 62,000 is the price that we're trading at, and we're going to sell the total amount of BTC that we have, around $50. What's going to happen here? Our sell order has a limit price of 62, and buyers are currently paying 63.5. So what are we going to do? Well, our limit order essentially turns into a market order, because what we're saying is sell immediately right now, as long as the price is 62,000 or better. And the system is going to look and say, well, yeah, someone's bidding 63,679, so we'll just sell immediately. It's basically the same as a market order in this case. It just goes through immediately as a market order. So you can do that if you want, but obviously you just type market order there. Let's do 65,000 like this. What you're saying is, I want to sell at 65,000. I'm going to sell this BTC. So we'll just confirm that. And of course, our price is too high. So again, we don't trade, right? Because our price is now too high for the current market. So we can edit that if we want, can cancel it out. We'll just cancel this order. And what we'll do is go market order. We're going to sell the amount of BTC that we have. And we're doing that at market. So we'll get this price, sell BTC. There you go. We've sold the BTC. That BTC is now gone. That goes back into the asset that we're trading it in this trading pair, which is USDC. So if I go to buy again, you'll see that my USDC is now actually gone back up to pretty much the amount that it was before. You'll notice that with limit orders, the instruction to the system is essentially trade immediately as long as the price is at or better than my limit. Now that's fine if you're looking to buy a little bit cheap or sell a little bit higher, and that works. But what happens if you want to trade a little bit differently? For example, putting in a stop loss order. What is a stop loss order? A stop loss order is an order where you want to get out of your trade at a worse price than the price is currently trading now, right? So let's say I buy Bitcoin at 64,000 and I think that the price might go up, but if the price goes down, right? Let's say we're trading in at 64,000 and I want the price, to go up obviously, but if the price does come down to this level, I actually don't want to be in the position anymore. And that means that I actually want to sell out for a loss, right? So if I buy here, right here, where the price is currently trading, and the price gets down to this level, I'm fine. But if it starts going lower, I actually don't want to be in the position anymore because this support level has broken, right? So this is the price coming down. You can see the price comes down, it gets supported up. Price comes down, it gets supported up. Buyers are coming in, right? So if the price does break, what the price chart is telling me is that, well, these buyers are no longer here and the price may be going a lot lower. I don't want to be in the trade then, right? So what we can do is we can actually put an order in known as a stop loss, which is where you buy at 64, comes down to this level, let's say 54, you're making a loss and you need to get out, right? Because you want to take a small loss instead of waiting for the price to go a lot lower. That's a stop loss. So essentially trading out of your position at a small loss to prevent further losses. Now, we can't use limit orders for this because a limit order, let's say we put a sell order in and we put a limit order and the limit order is 54,000. And we want to sell all of our BTC. What would happen there? Well, it's going to trade immediately, right? Because a limit order is trade immediately as long as the price is at or better than my current price and the price is better, okay? So it would sell immediately there. That's not what we want to do. We actually want to wait until the price gets down here to then take the loss. That's a stop loss order. Risk management sometimes. This is more for futures trading, which I'll get onto in a second, but we're not going to use a limit order in that case. If we want a stop loss, we have to go here to stop limit. So we're going to click that. We actually get another box to input now. A stop limit only enters a limit order when a trigger price is met. This prevents us from trading immediately, and it lets us wait until the price is at whatever price that we want, and then our limit order gets put in. So the trigger price is important here. So let's say I got in here and it was 64,000 and I want my stop loss to be 54,000. I can put the trigger price now, because I'm selling at 54,000. That means that only when the price trades at 54,000 will my limit order get put into the system. And the price right here is the limit order that you put in. So for example, if the price hits 54,000, I can put my limit order in to sell at 54,000. That limit order goes into the system. If the price trades around 54,000, I can put an amount in and then I'll actually sell. You can also put the limit order in at any price that you want. So for example, if we wait for the price to get down to 54,000, I can say my limit order comes in at 50,000. That means that I'll basically trade as soon as the price hits 54,000, I'll trade at any price as long as it's at or better than 50K. I can also put in a price here of, let's say, 65,000. What that would mean is that when the price gets down to 54, my limit order goes in to sell, but my limit price is 65,000. Now, if the trigger has been met here at 54,000, that means the price is at 54,000. My limit order goes in, but my limit order price is way too high, and so I won't actually trade anything. We're just putting instructions into the system to put our orders in exactly how we want. So obviously that's up to the individual. You wouldn't put it in at 65,000 because obviously your trigger price for your stop loss is at 54. So you can put anything that you want, but you have complete control over when the order comes in and at what price you trade at and the amount that you trade. Either if you're selling or buying, it's the same. Stop limit is where you're putting a limit order away from the price that would otherwise get traded. You don't want it to trade right now. It's mostly used for stop losses where you're actually selling for a loss away from the price that it is currently trading to prevent further losses. Something else really important about trading on MEXC is you may see this down here, fee level. You can see maker and taker. So we know what limit orders are and we know what market orders are. If you trade with market orders, you take other people's liquidity from the order book. These people are putting limit orders onto the system. They're showing their order. They're showing their price and the amount they want to trade. They are makers of liquidity. The liquidity is right here. They make liquidity. If we're trading a market order, we're taking their liquidity off the book. If you trade with market orders, this is the fee that you pay, 0.02%. You are a taker of liquidity and you pay trading fees on that. Now for right now, as I'm making this video, if you put limit orders in, you actually basically don't pay any fees. You're a maker of liquidity. You can put your limit orders in away from the book or away from the traded price, and you pay essentially nothing in trading fees because you're a maker. This may change over time, and it does change over time. But if you're a maker of liquidity that is using limit orders that are away from the price and you trade, then you pay no trading fees right now. If you're just trading market orders, taking other people's orders off the book, then you pay 0.02%. So it's a tiny, tiny difference. It's not going to make much difference at all. But hey, if you're using limit orders for right now anyway, you're paying no maker fees, tiny, tiny taker fees if you do trade market orders. Now we'll move on to trading in the futures market. If you're trading in the futures market, you have to take some assets that you have on the platform. You have to put them over into your futures trading account. So what we're going to do is actually trade with USDT here. That's what MEXC trade with. So what I've done is swapped my USDC into USDT. So literally just one to the other, just a trading pair, just like anything else. So you can go ahead and swap that. What I'm going to do now, because I'm in my spot account, is go to transfer. I'm going to go from spot to futures USDT. I just swapped an amount here, press transfer. That's an internal transfer, so that goes through immediately. That's taken from my spot account. Now we go into futures account. You'll have the USDT in here. So now we have some USDT to trade with. That's important because we need assets in our futures trading account to trade and to pay for any potential losses and margin our positions, because futures is entirely different to spot trading, which I will explain. To get to the futures trading page, you just go up to the top here and press futures. You should see it next to the spot trading page, and then you get here. So what is this? This is not trading crypto. You are just trading the price of crypto. So what we do here is we put some assets on this future trading platform in order to margin our positions. What does that mean? This is a synthetic derivative of the price of a crypto asset. So we're trading Bitcoin USDT, essentially Bitcoin dollar, but we're not buying and holding crypto. We're not selling crypto. We are just trading the price. So that's why, if you can see above my head, it doesn't say buy or sell. It says open long and open short. So what you're doing when you open a long is you are taking the long side of the trade. So you're buying from a seller and you're buying the asset and you're taking a long position. Now, if the price goes up, you make money. And if the price goes down, you lose money. That's with a long position. If you open a short, what you're doing is actually selling first. Now, remember, we're not selling the asset because we don't have the asset. We're just trading the price. So we are allowed to take a short position, which is a sell, and then we need to buy back lower to close the position. Well, so you benefit from the price going down because you sell high first and buy low later. Buy low, sell high, it's the same. But with longs, we're buying and hoping to sell higher. With shorts, we're selling and hoping to buy lower. So it's a long and a short. It's not a buy and a sell, but essentially it's the same thing in your mind, right? You're buying, going long, you're selling, going short. So that's it. Now, because we're not trading crypto here, we're just trading a derivative. We're trading the price of Bitcoin. That's it. We don't need any crypto. What we need is collateral to pay for any losses and margin our positions. So that if we do take a position, the system knows that if we do lose, we have the money there to pay it off. So how do you margin your position? You can use USDT. So another stable coin here, put that on. That's the asset, or that's the money that you have to pay for any potential losses. With coin, you actually put the crypto on. I think it's mostly Bitcoin and ETH. So they have a value and they are an asset that you can sell to fund any potential losses. You can do that as well. If you have the coin, you can put the coin on, but obviously that's more volatile because the coin is a volatile asset going up and down in price versus others. Whereas dollars is just, you have $1,000, you know that's $1,000, you know exactly what your position can win or lose before you get wiped out. So if you lose your trade, all your money can go from the futures trading position. So you have $1,000. If you lose $1,000, the system will liquidate you automatically, which is sell all of your USDT in order to fund the loss, and then you're out of the position. That's what liquidation is. We don't want to get liquidated, obviously. So that's why we trade with stop losses. This is much more for active trading and day trading, much more for kind of speculation or maybe even augmenting your investment. So if you have a long position, you've got whatever amount of Bitcoin in your investment portfolio, but we've got a bear market coming up or whatever, then you can take short positions just to augment. But 90% is investing and 10% is trading. This is the trading portion. So we know that we put USDT in to margin our positions. We can take long positions and short positions. And this is for shorter term trading where we can take longs and shorts or either augment our investment portfolio, whatever we're doing. When we trade futures, we can actually take leverage, which is where we can open a position in the market that is worth a certain amount, but we don't have to tie up all of that money in the position. And the reason is because, like I said, we've only got dollars on the system to pay for losses. And so the system doesn't care how big our order is. It just cares that we can pay for a potential loss. So this is where leverage comes in. I'll show you how to use leverage and also use it professionally. Leverage is dangerous because it makes your wins and losses much bigger and faster. And obviously, when you make wins, that's great. When you make losses, it's very easy to get liquidated, which is why when we trade futures, we always trade with a stop loss. We have an entry, we have a stop loss. It's a short-term trade. It's not an investment because it's very volatile and you probably will get stopped out without a stop loss eventually if you hold it for long enough, because we know there's a lot of volatility here. So what we can do is choose the leverage. This is isolated here. You can choose between isolated and cross. Most people choose isolated. This means that when you have a position, you have an amount of collateral that is tied up in that position, waiting to pay for any potential losses. Each position has an amount of capital tied up in it, separate from others, and that's it. When you go cross margin, what you're saying is all of your positions that you've opened are all call on the collateral that you have, right? So you may have 10 positions, you've got $10,000 here. One position goes belly up, it can wipe out all of your other positions because it's wiping out your margin across all of them. If you go isolated, that one position blows up, the others are fine. So most people use isolated. Cross may help in some ways to actually prevent a position getting liquidated and then it may bounce back, etc. But it can, sully all of your other positions and actually take them out if it's losing. So most people will use isolated. On the right-hand side, this is the amount of leverage that we're using. So let's put this down to a non-silly amount. Let's say something like, 5x leverage, like that. Press confirm. That means that each position is 5x, but you can change this around any way that you want, right? So let's do 2x, press confirm. Each position is now 2x margined. What is the margin though? What does that actually mean? Well, the margin is the amount that we have to put down in the position versus the actual size of the position in the market, right? So let's just do a market order and we'll choose an amount of BTC. Now what you'll see here, so I've got $150, and that means, let's just do the whole amount actually, 100%, right? So I've got $150 available here. What you'll see is that my margin right here to open a long position is $150. That means that actually with 2x leverage, my Bitcoin position in the market should be around $300 worth. So you're putting 150 down. You're trading with 2x leverage, so that's $300 worth. If I go 10x and actually put this up to 10, press confirm, my margin is exactly the same, 150, because that's all I have in the account. What you'll see is that the size of my trade now is 1,500 or thereabouts, because now I've got $150 in the position, but I'm using 10x leverage. That means my position in the market is 1,500. You'll see when I change my leverage, what happens is my liquidation price moves. So at 10x leverage, my liquidation price, if I opened a long here, would be 57,000. My short liquidation would be 69. If I change the leverage, let's go back to 2x leverage, what you'll see is that the liquidation price moves much further away. Now the liquidation price is 32 for the long side and 95 for the short side. Why is that? It's because I have less leverage, I have more cash to pay for the position and to pay for volatility versus the leverage that I'm taking. I've put $150 in and the size of the trade would be $300. So the thing can move, like 50% almost, right, with 2x leverage. And I'm fine, my money's there to pay for any potential losses. I'm not gonna get liquidated, no problem. So using leverage doesn't have to mean that you take more risk, right? What we can do is if we have an entry price and a stop loss level, we know our entry price, we know our stop loss, therefore we know the amount of risk that we're taking. And we know what the price can be as we're stopping ourselves out. If we know that, and we know that price, then we can manipulate the leverage that we take to essentially take as much leverage as is necessary as long as it's not within our stop loss price. So I'll show you how to work this out and how to take risk with leverage. You can use leverage without taking any extra risk whatsoever. You can also just whack up your leverage and take way more risk, because you can see your liquidation price moves very, very close to where you're entering. You have a relatively small amount of capital to pay for losses. For example, if you're using 10x leverage, you've got $1,000. That means 10x leverage, you've opened a position worth $10,000. If the price moves 10% against you, your $1,000 gets wiped out. So that's increasing risk, right? Because that is essentially saying a 10% move is going to wipe you out. Bitcoin regularly moves 10%. Now, on the flip side, if you made a profit there, then you're making a 10,000 trade and you're making 10% profit, which is $1,000. So that's great, but that's actually 100% profit on your cash that you put in. So you can make more quickly, you can lose more quickly, but you don't have to take extra risk if you don't want to, if you know your entry and your stop loss. Let's go through a sample trade then and see how we can use leverage in a professional way. So just like the spot market, where we saw that we're going to get in at around 64,000, it's actually 63.5. We're going to get in here, right where we're trading now, in a long position. And our stop loss is going to be this level, where we had support twice, where buyers came in. Now, we're happy for the price to go down to this and bounce again, but we don't want it to go down here. So what we're going to do is take a loss right at this level using a stop loss order. So we're going to go long here, we're going to put a stop loss here, and then obviously we'll get out. So what we can do is figure out how much risk we want to take in comparison to our portfolio, and we can also work out where our liquidation price is. And that means we don't have to take any extra risk. So what we're going to do is go over to a position size calculator. I'll leave this one linked in the description, but whatever you're trading. So we're going to open at 63,500. And we're going to stop ourselves out at 53,000. We can then put that stop loss in here, and our account balance 10,000. We're going to risk, let's say 5% of the portfolio. Most traders will say anywhere from 1 to 3%, something around that, right? So you don't want to obviously risk your whole portfolio for one trade. 5%, that's fine. We know that if we have a $10,000 account balance for our trading portfolio, this is the amount of Bitcoin we can trade. We can obviously put any amount in. So that just moves a decimal point if you have a smaller position, whatever. So we know that this is the money at risk. 50 of a $1,000 portfolio is 5%, 0.005 basically, right? So that's the amount of Bitcoin we can trade whilst risking the amount of our portfolio that we want. Now we can go back to our trading system and we can enter the order exactly how we want, knowing exactly how much is at risk. So we're going to trade with isolated margin 10x. We'll just leave that as it is for now. So if the order size calculator has shown you how much you can trade of BTC, you can see quantity BTC here, something like that, right? So you know that if it's 5% of your portfolio, whatever, you can trade this amount. So you can put that in. You can also change this to dollars if you want, right? So if you change it to that, then you're just essentially trading like an amount of dollars, right? So I want to trade $150, 10x leverage. I know that I'm trading a 1500 position, something like that, right? But if you're using the order calculator, it's probably best to go over to BTC, because then you know exactly how much of the BTC that you're trading, whatever that is that you want, right? You should know your order size before you get in. So you know the order size, and the other thing that we need to know is the stop loss level, because we're trading here, so we have a trade idea that we're going to actually go up, but we want to take our loss here at 54,000. So go to TPSL, trigger price here. We're entering a trigger order. Like we saw earlier, trigger order only triggers at the current price because this is going to close our position. Notice it's not buy and sell, it's open long, open short. If you want to get out of the position, what you're doing is closing the position. So this would be a close, and our trigger price, 54,000. What that means is that if we're getting in right now at 63.5, that's a market order. We're trading an amount, trading 10x leverage, and our stop loss is 54,000. Now, with 10x leverage on this order, and I've just put an amount in here, you can see that the liquidation price would be 57,000. Okay, that's not good. That's way too much leverage. Our technical analysis, or our trade idea, wants the price to come down all the way to 54,000 before we get out. We're going to get liquidated before that, which means that our risk is too much. Okay, so we're going to get liquidated at 57. So that's not our own risk and strategy that we've put in, right? So we're using too much leverage. So we can go change this to 5x, press confirm, and the liquidation price is now 51,000. Our stop loss is 54. That's an appropriate amount of leverage because we're not taking any extra risk, because we've already seen that 5% of our portfolio in the order size calculator as a loss would be 54, right? If it's 57, we're losing more of the portfolio, we're taking more risk. But the liquidation here at 51 is fine. Our stop loss is 54. So it's away from the stop loss that we've given. So we can do that, right? So you can put that stop loss in right here as you open the order. So market order if you want, isolated 5x margin, put an amount in here, you can open that long. So let's go ahead and do that. Open the long, and that will open for us. So now you can see that we've actually got the long position here. You can see the amount of the order, you can see the entry price, etc. Fair price, you can see the liquidation price is 51, margin ratio right here. We have an unrealized P&L. Unrealized P&L is you've opened the order. What is the actual profit and loss right now in the order? That's unrealized because we've not closed any of the order yet. You can close certain amounts of it. So for example, if you want to close long here, you can see this. You can put in the close order. So if you want to close 50% of the order, right, we can know how much BTC is actually traded right here. So we have this amount of BTC, 0.005. We're going to go over, we're going to like this, right? And then the price, let's say whatever price it would be, right? You would close, but we'll do market order here. We're closing 50% of the order basically. We're saying that we have an amount that we're trading. We want to close 50% of it, which is on this occasion, this amount of BTC. Close long, you would close 50% of the order, right? And if you're making a profit from that, that would come as a realized P&L because you've now closed an amount of that order and it's now a realized P&L because you're not taking that risk anymore. It's now out in your account. So that would be a realized P&L if you're making a certain amount there, right? You'd also have a loss there if you're actually closing at a small loss, but you would close long an amount there, right? So you can do that. This TPSL, we can actually edit this. So if you want to change the stop loss that you've put in when your position is open, you can do that here. So maybe let's change it to 53,000, gives us a little bit more space. And if you want take profit settings, right? So you know that you want to take a profit at 68K or something, you can put that in here and you either close an amount like 50% or you close the whole thing. You can put that all in here as you want, right? And then down here, we have flash close. That closes the whole entire thing at once. Now notice it's not buy or sell because we're opening and we're closing. So what we're going to do is flash close and that closes everything. You see that? Close long, that's it. And it takes everything out. Notice that it takes our position out and it also takes our stop loss order out because our stop loss order is a sell order basically, but that's closing the buy order that we had. So we went long and then we were going to go short the exact same amount to close out our order. If that doesn't get deleted and the price gets down here, you actually open a sell order, which you may not want to do. So that's what open and close is. You can see open and close. So for example, if you have an open position, so you've got a $1,000 Bitcoin position, what you can do is close an amount of that either by going down here to the order here and doing like we saw, or if you want to put it up here on the right hand side, go to close. That's essentially the same thing. So if you have a $1,000 long, you can say, I want to close by market, half of my order, close long. You can see on the right hand side it says close long. It doesn't say sell, it says close long because you have a long and you're closing that by going short. So you're closing 50% of it or whatever. Opposite for the sell side as well. So if you do have a short, you can close some of that short by closing short right here. That's actually buying back, but you're closing the short there. So that's how you manipulate orders and enter orders exactly. You don't have to take more risk when you're taking leverage. If you want into MEXC, you can get a deposit bonus via the link down in the description below. I'm James, it's my ZG. Cheers for watching, and I'll see you in the next one.